So this is more of an investment strategy, and everybody's got their own investment strategy whether it's dollar cost averaging, and this is more based on the positioning. So the investment and how it works is like many facets. There's the position sizing of the portfolio. There's the factors and how it's weighed and the different sectors of exposure, and the amount of beta that's in the portfolio, and Sharpe ratio. This one's just really keying on uh, entries and like lowering, averaging down, laddering down, averaging down, bringing down your average, and that's basically investing only when there's like a down week, a down quarter. And I bring up this chart of the year dollar futures because it has the cycle, and the cycle means something, especially the green and the non-green zone. The green zone is typically just a nice upward trend for 5 to 6 years, starting at the beginning of the cycle. And then once we hit the end of that, then we start to have maybe a smaller run. When it comes up to that glove kind of look and shape at the very top, right up here, into the hand portion outside the thumb, and making the Nike swoosh. This is a small stint of just possible non-recessionary period before we're just totally in the fragility zone. But this non-green zone of the 22, so out of the 22 years of the cycle, minus 5 to 6, so around, like, I think if there's it would be around 17 if that was like 5, and if it's 6 it's 16. 15 to 16 years of the cycle is risk off, like a fragility zone. I wouldn't say it's necessarily risk off, it's more fragility, and I would say it's risk on for investing in the lows. And we can figure out when we're getting close. One is the looking at the treasury yield inversions, and the most recessions that's ever happened in this risk was it the fragility window is 2 to 4 recessions, and the goal is just to buy at the bottom of the recession and just be prepared for it, because most people aren't prepared. Their average strategy is just dollar cost average, and it's unknowable when these recessions are coming. And I'm saying, no, you could prepare for it. You could prepare for it so that you have a whole boatload of money to buy at the bottom. And I don't know, it might be, this is just an overall strategy, meaning that you'll be able to beat most, but at the same time, if we are having lower and lower asset prices, not even the best strategy can survive that. Just because we're assuming that the market will continue going up and up and up, but that's not always guaranteed. So there are some limitations to this, and it is just a strategy, and it's very similar to just the dollar cost average. It's just more purposeful and more sequence driven. And there's different ways to get alpha. There's definitely backing the right company, but at the same time, there's having a really good position and price position. And that's kind of what we're really after. It's just getting a lot of dry powder and putting it at the very bottom, and then letting that do the heavy lifting, as well as having a good fundamental company. And Warren Buffett, he has some really good sayings about a quality company at great prices is better than an okay company at high prices. Like he has these different sayings, but we're really focusing on buy when there's blood in the streets. When other people are fearful, be greedy. And that's what this fragility window is all about. It's basically liquidity, and the long-term debt cycle is just not unable to support just whatever is going on, whether it's the leverage or just the policy breaking. It happens during this time. And so we're going to go into the strategy. So the overall strategy, without adding too many layers, is just to buy at the lows. And there's many ways to do that. So whenever we're in the fragility zone right now, so how would I go about doing that? So one way is definitely, for one, we could test I wanted to test it. So around the cycle from 1991 to 2013 is the the cycle window, and then 1991 plus 5, but this is at 1996, is when we saw a lot of growth. And obviously, we didn't get to see 1996, but we had some nice growth up here into from 96. Let's see, 91 plus 6. So, I mean, that kind of ended right around here. We don't know where it came from exactly below that, but we could look at the timing solutions. We got the Dow here, and we could see, we could zoom in to like around 91, going to 96. So 91 is right here. That's the beginning of the cycle, and then going to plus 6 to 7 years. It looks like we had, let's see, 6 would be 97. So we had a good amount of growth. It looks like it went on all the way to 2000. So it looked like it kept on going, and then once we hit 2000, we hit a peak, and then we started to chop a bit, and we could go sideways, and we could see the amount of chop at just the amount of bottoms we had. And this is definitely the fragility zone. Like if we were to say that it's 22 years this cycle, we started in 91, and the green zone ended at 97, roughly. Then we could see that it chopped it. We actually came down to the lows, and we revisited it again. And if we just decided, okay, this is the fragility window, now we're just going to save and buy at the lows. And let's just say this was like a nice low. We saved till 97, and then we're like, okay, this was a nice low. We're waiting for it to come to there again. And say we just deployed money right at these lows, at this low, at the same low every time, and then we made it to the green zone, which was 2013. We made it to the green zone, and boom, now we're off again. And we had this huge position built at the very bottom of those lows. You would think you would do really well, and then we did it again. We hit the green zone at 2013. We took off plus 6 years, puts us at 2019. And we had a lot of chop, but here's some lows. And it looks like we definitely, it was like 2018, 2019 that we started chopping around. And now we're into the fragility zone. We plunged pretty deep here. And, the idea is that we'll reach these lows again. And if not like exactly at the lows. We got this low and we got this low. And the idea is that we're going to see it sooner than later, within this before 2034. And we've had one recession so far of 2020 in this cycle. I think maybe there's one in 2018, but for the most part, maybe there's been two already, and we have the possibility of having two more. So the idea is to position at the lows. So that's kind of just the overall practice. If I were to find a way to target the lows, one way is definitely using market structure breaks. So if we open up the market structure, we go to the weekly, and we just listen to the breakers. So this one's got a lot more lines. So if we were to kind of do the replay here, we could see here that we got a naked breaker here that we could go to, and we just played it. Or actually, let's go towards 2017, 2018. So this is kind of, we were thinking where things would, the fragility zone begins. So plus 5 or 6 years from 2013. So 5, it's 2018. 6 would be 2019. We're at 2018. And then we're saying, okay, we're going to buy at the lows. Let's just say we buy at this weekly breaker here on a retest, and let's see where it goes. So we're going to put it to times 10 just for time's sake. And then looks like we're struggling here a bit. We have a chance of reaching it. Oh, boom, there it is. We got our order filled, and we bought at the bottom. Okay, let's target this breaker at the bottom here and see how we do. If we get close, or we'll buy at the lows. Like if we can't reach the bottom here in this breaker, we'll we'll do a reclaim of this low here. Let's go ahead and just map it out too. There we go. Oh, we're just kind of moving at the same time. Okay, we're going higher and higher. We're like, okay, keep going. Oh, here, we're getting a chance. Oh, we even hit the breaker. So we got filled all the way to the bottom. So, like, that's something that's kind of like a really interesting phenomenon there. Like, we hit both of those weekly breakers, and all we had to do was just wait. We could have just saved and saved and saved. And instead of just poor old dollar cost averaging, we could have just waited for this weekly breaker and until we hit it, and then put all our money in that time for a nice deployment of just getting the lows. And that's something that's just with this strategy, this is one way to find these lows. Another one is definitely using this naked pivots. So these are like fair value gaps. Like it's just inefficiencies that the market's trying to fill. Now we go to the naked pivots. I like to look at the high time frame naked pivots, and here we are. One is the quarterly, one's the weekly. So the quarterly, we could see that during the fragility zone, we were able to see these naked pivots down here on the quarter, and we still got one all the way down here. That's why I'm saying, like, hey, we might this strategy might not always work, because we might always come back to a naked pivot all the way at the bottom. I mean, and I think this is still up for grabs too down here. But if we can't reach those, then the weekly is the next best one for just naked pivots. And we got one here at the lows. And I mean, we had one here at this low. We were waiting for it to touch. And then technically this one here, grabbed that one. This was not really naked pivot, but it was something that we treated it like it was. But yeah, this one definitely, we're going to expect it to come near the lows here and maybe retest that breaker. I have no idea. Some liquidity down here and then come back above. But like this is kind of another way to find these zones, and on top of like these, auto support and resistance Fibonacci lines. But that's kind of just the point here, is just the quarterly and the weekly here for the naked pivots, and then the naked breakers here on the market structure just serve as really good just magnets of obviously fair value gaps are pretty close to these areas, but just serve as just really good instruction points for this fragility zone of where to buy. Okay, like, oh, it's fragile, all my savings, we're gonna just get ready to deploy it. But then when it hits the green zone, maybe we can like dollar cost average every down weekly close. And that's kind of just the idea of that, or down quarterly close, or we could go even faster, down weekly close, down monthly close. But that's kind of just the idea once we hit the streak period. Specifically, when we look up here, the streak period 2013 all the way to the streak period is 5 to 6 years, so 2013 to 2019. This nice streak period. Barely anything that was down. We had one down quarter, I guess three. It had two side, I guess that is two down quarters in that huge streak period, and then one more in 2018, and then we started to hit fragility. But roughly 2, 3, maybe 4 down quarters to really deploy on the way up. And or you could just I guess deploying all the way up, down quarter and down week, 1/3, 2/3 would be another part of the strategy. So that's basically it. Is just when we're in the fragility zone, we're really saving up money for the stockpiling events. And then once we're trending, we're in the green zone. We definitely invest on the down week, down quarter, 1/3, 2/3. Averaging down the position. And the whole goal is just to have a really low position. The lower the position, the better. The more alpha we actually have just by positioning. And that's just the whole idea based upon your dollar future cycle. And using treasury inversions as just an idea to get ready to be saving, to really amp up the savings, so then you could be positioned really well when there's blood in the streets. So that's the part one of the strategy.